Alicia, yeah, let's turn back to the major indexes. Strong end to the day. We see the major indexes higher with the exception of the NASDAQ, under pressure, of course, amid a busy week of technology results and a rising 10-year Treasury yield. Joining me now is Thomas Hayes, chair of Great Hill Capital. Thomas, we're back in the record high territory. The S&P notching a 6-day win streak. The Dow in today's session hitting a record high. What is working in this market?
Well, everything's working because we came into this earnings season with a lot of pessimism, Kristen. And you saw that expected earnings growth for Q3 was going to be 27.5% year on year coming into earnings season. And if you look over the past 5 years, the average beat is about 9%. And the last 5 quarters is 19.1%. So I think very few people are looking for a number close to 40% or greater earnings beats for this quarter. And what's interesting about that is less what happened in Q3, but more than that is the fact that companies are now going to have to take their guidance up. And coming into this, estimates for 2022 had been flat and sliding down the last 4 weeks after 6 months of increases. The S&P earnings expected for $220 for next year. We think that as we get through earnings season over the next couple of months, we're going to see 2022 earnings estimates jump to 230 and beyond, and that's going to make the market look a lot more reasonable. So a lot of the fears coming into this earnings season, we believe, were overblown.
Okay, so I do want to talk about that because we had a guest, Christine Short, on, an earnings guru, if you will. Her focus is earnings. Just a few days ago, and she was saying she actually thinks once we get to the first quarter, these earnings are not going to be looking so hot, and we could even see some weakness here in the fourth quarter, just as stimulus wanes, and the big growth that we had seen earlier on in this pandemic does start to slow. But Thomas, it sounds like you have a different view on that. Why is that?
Yeah, I think, a lot of people are worried about the labor shortages and the supply bottlenecks, and all of these things are short-term focused. And if you get caught up in the short-term headlines, you really miss the big picture. Jamie Dimon laid it out last week, CEO of JP Morgan. He said the supply chain issues are going to be a non-issue. And if supply chain issues were going to be a major issue, we wouldn't be seeing near record margins, net profit margin of 12.3% this quarter, even in the face of all the problems with Delta, the bottlenecks, and that compares to the last 5 years average of 10.9. This will be the third highest net profit margin in recorded history, behind the last 2 quarters. So margins have come in marginally, but they're still well above the 5-year average. And we're seeing guidance go up with these companies as we get through Delta and as some of these costs come out of the system. And those companies that can raise prices have done so to retain margins. So the pessimism is unwarranted, and we're going to see it in the guidance moving forward as 2022 earnings tick up.
Okay, bond yield spiking 1.65% on the 10-year Treasury, highest levels since mid-May. What's behind this? Is it the better than expected results indicating that this economy is really, making some strides in its recovery?
Yeah, well, I think at the last press conference, Chair Powell signaled that he wanted to move ahead with taper as fast as he possibly could. He'd met the substantial further progress standard on inflation, and many could say, and then some. But he hasn't met it on full employment. And we certainly didn't get it in the last jobs report. And he's not going to see another jobs report before the November 2nd meeting. So our view is non-consensus. We believe that decision is going to be pushed off to December 14th or 15th. And we think that he'll have the data from the October and November jobs reports, which will be better than September because Delta's in the rearview mirror, because the extended unemployment benefits have rolled off and people are getting back to work. So we do think that they will announce in December and likely implement in Q1 of 2022.
Okay.
So in that context, as rates have risen, we've seen a move back to the reopening trade, and as a relative outperformer value in cyclicals, but we also do see pockets of tech also performing because people got too bearish into Q3 earnings, raised too much cash, and now they have to chase into the end of the year.
Interesting. So we have technology names, a whole host of them, reporting earnings this week. Netflix yesterday, Tesla today, Snap tomorrow. They'll all roll in throughout the next week as well, Thomas. What takes this market higher from here? It's a different market than it was a year and a half ago when unprecedented stimulus first, surged into the market. Is it technology names or is it other companies that can keep this market climbing?
Yeah, well, if you look at the bottoms up 12-month price target, they have it about 11.5% higher than today. Consensus is 50-50 on the S&P 500, actually 50-51. And that is reasonable. What's going to drive it higher is earnings. And, people saying stimulus winding down, we're going to get, it looks like another $1.9 trillion, $2 trillion in spending with the infrastructure and Green New Deal package, the social spending package that's coming down the pike through reconciliation. So that's going to be a driver. But in this context, what we want to do is look for high quality stocks, even if the market's fairly to a little richly valued in the short term until those estimates go up. We want to look at those companies that have come down in recent months that are high quality. And the one we love is Cigna, which was up today. And why was it up today? Because UNH last week beat on top, bottom, and guidance, top line, bottom line, and increased their guidance. And then another peer, Anthem, did the same thing this morning. They beat on top line, bottom line, and guidance. And we think we're going to see the same thing on November 4th for Cigna. It's trading at 9.5 times next year's earnings compared to its average historical multiple of 12 times. We think this could actually work up to new highs and outperform the market in the next 3 to 6 months. And the reason that it traded down in the last 3 months is because the medical care ratio, the COVID cost, the short-term COVID cost from Delta had an impact on the short-term earnings. We believe that's subsiding as we saw in its peers' earnings, and we think that's a tremendous opportunity in this environment. And then the second one is Boeing. We're seeing international travel coming back. We saw Boeing increase their guidance, expecting China is going to need $1.47 trillion of airplanes over the next 2 decades. Yes.
I got to jump in. We got to keep this conversation going, but we do have Tesla earnings that are out. I do want to send it over to Alicia, my colleague, with those results.
Yeah, Kristen, Tesla reporting a beat on the top and bottom line here, reporting records in many respects. Let's give you the top and bottom line numbers, though, first. $13.76 billion in revenue is what the company is reporting right now versus what was expected, $13.62 billion. Just for some perspective here, last year, the company reported $8.77 billion. In terms of that bottom line number, the company is reporting $1.86 adjusted. And in the after hours, the stock not responding accordingly, despite kind of a lot of the optimism in this report. Just breaking down a little bit of the information that we've got here so far. Again, Tesla reporting in this third quarter. This was a record quarter, according to the company, in many respects. Some of those respects, the company saying that it achieved our best ever net income, operating profit, and gross profit. Pointing to those profits right now, operating margin, it's 14.6%. Just for, again, further perspective, last quarter, the company touted an operating margin of around 11%. So an improvement in margins here, there. Also, the automotive gross margin, the company reporting 30.5% versus last quarter, 28.4%. The company also noting, and something that investors obviously looking forward to understanding a little bit more, is about EV demand. The company saying that EV demand continues to grow throughout the structural shift. A variety of challenges, though, the company cites here, including semiconductor shortage, congestion at ports, and rolling blackouts have been impacting our ability to keep factories running at full speed. But the company does have a mention here of the Shanghai Gigafactory, saying additionally they're continuing to ramp up the Gigafactory in Shanghai, building new capacity in Texas and Berlin. Although not fully explaining that capacity, I'm sure we'll get more of that on the earnings call here. Tesla also saying that it continues to run production line as close to full capacity as conditions will allow. We do, of course, note those conditions that we mentioned a moment ago with the semiconductor shortage, congestion at ports, and so on. So a nice beat, top and bottom line, good improvements in the margins here, but in the after hours, the stock kind of not popping the way you would anticipate. Kristen?
Thanks, Alicia. Yeah, I see the stock in the after-hours movement relatively muted for a company that, of course, does see a lofty stock price, just about 4% from its all-time high of $900 a share. So collectively, I think this market's still very bullish on Tesla, despite new entrants. GM and Ford spending tens of billions of dollars collectively to push into the EV space full throttle, not to mention the competition that Tesla faces from abroad. So I think a move in stride here. We'll wait to see what happens on the earnings call. Notably, that Bitcoin-related impairment of $51 million in the quarter might be a reversal here as we see Bitcoin soaring to new highs in the current period, but we still have several months to go in this current quarter, so something that we'll be watching. Thomas, I want to bring you back in. I hope you stayed with us there. We wanted to get to this breaking news. What is your reaction to these Tesla results and what it means for the market?
Well, I think the results are strong for sure. We're not going to know what we need to know until the earnings conference call at 5:30 p.m. It's unclear whether Elon Musk will be on the call. I know he referenced in the last call he might not do them anymore, but my guess is he'll show up. Leaving that aside, the reason you're seeing probably a subdued response with the stock is, Tesla came in hot into this print. So the stock was up 12% since they reported their deliveries earlier this month, 241,000 vehicles in the third quarter, which was up 20%. And 12 to 15,000 beyond expectations. It's also up 35% over the last 3 months. So this could potentially be a case of buy the rumor, sell the news. But I think the markets just show me what you have on the conference call. We want to hear what your outlook is moving forward. But looking at these margins, looking at the top and bottom line, certainly impressive numbers. How you wrap your mind around the valuation is challenging. The consensus 12-month price target on the stock is $669. It's trading at $854 and change. So, how you get there is hard to see, but we'll wait for more color from the conference call. But by and large, top line, bottom line, margins, all very, very strong and impressive at this point. The conference call will tell us more.
And the stock down about 1.2% in the after hours, jumping around a little bit here. Thomas, we got to leave it there. That's Thomas Hayes, chair of Great Hill Capital. Thank you.